Erin Brewer, welcome to TITV. It's great to have you here.
Thank you, Akash. I'm delighted to be here.
Well, Anita and I are so excited for this conversation. There's a lot to get to. So I want to start with M&A. I mean, Lyft has done some exciting M&A recently. You bought Free Now, which expanded you further into the European market. You brought TBR, which expanded you more into the luxury chauffeur market. Can we expect more M&A in the months to come?
Yeah, first of all, let me start off by answering that question by saying what a privilege it is for us as a team to be here where we are today. If you think back 2.5 years ago, where the business has come, it's just incredible to be at a point of financial strength that we can really think about not only growing up, but growing out. And so you mentioned the acquisitions we've done, Free Now, which has really expanded our footprint in Europe, and then TBR Global Chauffeuring, which is just one of the pieces that really build out that incredibly important sort of luxury and really allows us to serve the business consumer in a much more comprehensive way. It's really exciting pieces of our strategy that begin to come together. I walk you through that because I think it gives you a sense for how we think about supporting the growth of the business. We're fortunate to be in an industry that has incredibly healthy organic growth and
Right.
lots of opportunity across geos. And so, we're always looking for interesting ways to continue to support that growth.
You mentioned the financial profile of the company now, and you guys have done some great work getting yourselves to more than $1 billion in free cash flow for the trailing 12 months. Those two assets, Free Now and TBR, are they free cash flow positive?
Well, look, when you think about Free Now and how those synergies will be generated, first of all, it's a nice little business in and of itself. It plays in the taxi space in Europe, which is a premium product. And really, what they're great at doing is bringing fleets on. What we're great at doing, going to do is tweak those algorithms that are really going to raise the efficiency levels. And then you add on to that things like our partnerships, which is a huge strategy for Lyft domestically in North America today. We partner with global companies. That's going to expand. Our media business is going to expand. So there's layers of synergies where we can take that core performance and really accelerate it. The
Hmm.
same with TBR Global Chauffeuring. It's an incredible business in and of itself in terms of the top line, its profit profile, its cash profile. You put it on the strength of our overall platform, and we have incredible opportunities to accelerate that.
So it sounds like both of them are generating free cash flow. The
Yeah,
idea is
both of those businesses generate they're slightly different levels, but they do today, and they'll be positive contributions to our overall cash profile.
right. Well, last question before I hand it over to Anita is, as you think about M&A, how do you preserve that free cash flow profile then as you seek to build out the company further?
Well, look, just the organic piece of the business is an extremely strong ongoing cash profile position. So we expect to convert, we talk about it as a conversion of our adjusted EBITDA. We expect to convert that at very high levels as we look out over the next couple of years. So we see extremely strong runway in terms of healthy cash generation profile. And that's going to support what is our capital deployment strategy. And it's really kind of three foundational layers. One, ample liquidity. This is a hugely scaled business, so ample liquidity to support the operation is incredibly important. Supporting our growth, whether it's through organic growth or opportunities that we see to accelerate our growth in inorganic means, is another piece of that strategy. And then we obviously announced an inaugural share buyback program at the start of this year. $750 million is the size of the overall program, and we'll complete $500 million of that program by the end of 2025. So
Hmm.
really around reducing our share profile, ensuring that we've got our eye to that, from expanding investor value is really critical and important. Those are the three layers of our program.
Erin, I wanted to ask you a little bit about your rationale, just staying on the topic of M&A here. What was the customer research and analysis that convinced you ultimately that in these areas of your recent acquisitions, it was better to buy than to build?
Yeah, absolutely. So, if you think about Free Now and Europe, that's a landscape that's an attractive market. Those rides tend to carry higher values. Free Now had really carved out a niche in terms of aggregating taxi that we found extremely attractive and we thought was going to be a platform for which we could actually add value, right? You want to find that classic 1 + 1 = 3 in any M&A transaction. And we obviously did deep research in the markets. They operate across 9 markets, the characteristics of the market, the customer profiles. It's a heavily, business-oriented traveler. That's a great profile for us to participate in and accelerate that growth. And understanding, again, what else we could bring to the table that would ultimately be of value, both in terms of the fleet side or the driver side on FreeNow, but also to the rider. We think about that very in depth. And then if you think about TBR Global Chauffeuring, this is really, again, at the highest end of a premium offerings. We have been focused on a very specific strategy to increase and accelerate the growth and the value at our premium ends. And in the third quarter of this year, for example, what we've talked about is that growth at that higher end piece of our ride offering was up 50% year over year, and we're just getting started. So TBR really adds a capacity as we think about, in particular, targeting that business traveler, engaging with partners around events to provide, in addition to the core premium rides that are available on the platform, really that next level of incredible service that really round out the offering and make us differentiated in the market.
So you talked a little bit about TBR. I wanted to double click on FreeNow a little bit, Erin, because I listened to you talk at the Nasdaq recently, and you mentioned a lot about smaller cities in the U.S. and how these underpenetrated markets in North America have been a great source of growth for you. FreeNow obviously is based in Europe. You guys have also been expanding a lot in Canada, and I just wanted to ask, what are your geographic expansion plans, big picture, going forward?
Today we're obviously incredibly focused on where we operate. The US and Canada, our traditional markets, still have strong growth opportunities ahead. You've mentioned underpenetrated markets in the US, which has been a strong source of growth. And don't forget, even in 2025, we continued to launch new provinces, new cities across Canada. So as we think about 2026, again, a lot of runway for growth. And then Europe really presents a new front for us. And so the teams, as we closed the acquisition in the recent months, got right to work in terms of capturing that initial, beginning to capture that initial synergy profile in terms of just improving the core way that that business operates. And we're really excited for what comes ahead. So we've got a lot on our plate to execute that we're excited about, and a number of different growth trajectories that we're pursuing. So we're very focused on that.
I think it's a good time, Erin, to get into a topic that is top of everyone's minds today, especially after our story earlier that Waymo is in talks to raise funding at double its last valuation. I think everyone is thinking about AVs, using AVs in San Francisco and other cities.
Mhm.
You guys actually bought an interesting asset in 2020, Flex Drive, and you've been using it to service and clean some of the vehicles associated with your partnership with Waymo. And I've just been thinking, Uber, also your competitor, has similar partnerships with Waymo, but they've taken a different approach. They use third parties for sort of servicing and cleaning the cars. So I wanted to hear from you. Has owning FlexDrive been an advantage? And how has that helped you?
We absolutely think owning FlexDrive has been an advantage and will continue to be an advantage. At the advent of this industry on AVs, which is still frankly quite nascent, I think people sort of forgot for a minute that having very high availability of this technology was a critical foundational layer, right? If a vehicle isn't available to be deployed, to be hailed, then you're not optimizing your revenue generating opportunity. And in order to do that, you need to have incredible operational excellence behind it. We knew FlexDrive was absolutely going to be a superpower, a secret weapon, if you will, in that overall mix and in that conversation. And we have high confidence that it will continue to be. What's unique about it is, yes, it's a fleet management capability. We own over 10,000 cars today. We operate in over a dozen major cities with physical centers. So that's important. But what's incredibly important is it's optimized for rideshare. And that's incredibly unique, and we think is going to be incredibly valuable as we think about the continued build out of the AV landscape, as you think about ride hailing in a hybrid world.
So it sounds like then, with respect to margin structure for autonomous vehicles, I mean, if you look 3 years out, how do you think it changes your margin structure?
It's interesting because today what you see across not only Lyft and all of the partnerships that we're engaged in, but across the industry, you see a high level of experimentation with many, many different models. That I think will continue for certain over the near term. And as people begin to, figure out the models and more importantly, figure out exactly where they want to play, and I'm talking up and down the value chain, I think then that will be the point where we'll come into focus about exactly how it will fall into our overall P&L structure. But what I can say to you is that we are incredibly excited about the advent of AV technology. We see today that it expands the market. We see that in the cities where AVs operate and have
Right.
been operating at some scaled fleet. And we know and have high conviction that a hybrid network, so the ability to service riders incredibly efficiency, whether it's a human driver, an autonomous driver, is going to be the winning model. And so net, this is great not only for our top line growth, but as we
Right.
continue to seek to expand margins.
But I guess as you think about that, I mean, do you think that prices in the long term will have to come up to be able to offset the margins? Do you see the costs coming down? How do you think about that?
If you're talking specifically about autonomous vehicles, you have
Yes.
to go down a laundry list of sort of assumptions and inputs. The most critical being around how will the hardware ultimately scale and where will that cost land? Then you have to understand where will the regulatory and sort of insurance structure land overall. And so there are a number of years here for that to develop so that we know those inputs with a lot more certainty at scale. And I think that will influence ultimately where the pricing dynamic lies in the overall market. That being said, I do think we will reach a point at scale. It's certainly not going to be next year. It's going to be multiple years down the road where that all becomes, much more into focus so that we understand the structures. But ultimately, if you think about whether it's autonomous, human driven, the hybrid network, this has become really an essential way that people get their transportation needs met. I think autonomous will expand that overall. And so it's critical that we continue to be able to deliver a competitively priced service that
Mm.
delivers very, very high levels of service.
I think it's clear that we're in earlier days in terms of AVs, Erin, but one area where you guys have expanded a lot already is by adding all these new partnerships. You have partnerships with DoorDash, United was one that you talked about on the last earnings call, Hilton. And I just wanted to ask, this affects your long-term margin structure as well. In these sorts of deals, who is paying who?
These sorts of deals, generally are constructed where both parties are contributing, right? So you've got a co-funding mechanism. And that's incredibly important because to build durable partnerships, you need both partners to be really in it to win it. And what that means is you go into this understanding that both have a deep interest in, introducing new riders or new consumers to the service, building loyalty, building high engagement, building higher frequency. And you see that throughout the life of a program with investments, with different campaigns to grow it over time. And Lyft has a track record of doing that very, very successfully. Rides that are tagged to partnerships have grown significantly as part of our overall profile. And those rides, contain very, high quality characteristics, meaning those riders tend to take a higher mix of higher value rides. So they tend to bring higher than average profitability. So deepening our partnerships and continuing to penetrate that opportunity has been a huge focus and will continue to be so as we think about 2026 and beyond.
Can you give us a sense of what that funding split might look like for any of your bigger partnerships? Say, let's take United.
Yeah, it varies by partner, so I'm not going to go into details, but it tends to be balanced and it really also is informed by what stage of the partnership we're in, what cohorts we're going after. So that's sort of the general color that I'll provide.
Got it. So, moving to another area, Erin, the FTC, we got news this week, is suing Uber over its Uber One subscription program. And I've heard you guys say a lot before that you're fundamentally a rideshare company. You're not looking to get into any other areas outside of riders and cars.
Okay.
And I was just wondering, where do you personally spend the most time in terms of thinking about regulatory affairs? I mean, is it insurance? Is it worker classification? Is it something else?
Yeah, I mean, first, maybe touch on your initial point, Anita, because I think it's a great segue from what we were just discussing in partnerships, right? So, riders on the Lyft platform and the way they engage with partners are very, very different. So, you're someone who loves rideshare and you also love food delivery. We've got the best offering in the industry with our Lyft and DoorDash partnerships. Same with United, et cetera. So, we think that's a great model, and we're excited to continue to grow that. In terms of the regulatory landscape overall, it's important when you operate a service that is so essential to the transportation environment that happens with cities that you go into it with a mindset of really partnering, both locally at a state level or federally. And that is the way that we have gone about this as a company. We think it's been a winning model overall. It's something we also frankly really liked about Free Now. And so the regulatory environment is present in all aspects of our business. We partner extremely closely, and we think about it from the lens of, some of um, the areas that are more present has been around some of this reform in California around insurance, which we're excited about. It's going to kick off in 2026. And we think that that could present a canvas, if you will, for other states to do some accelerated, what we view as common sense reform in overall rideshare insurance marketplace in the United States.
So, Erin, I got to ask, you're a CFO, you make tough capital allocation decisions every day, I'm sure. What is the toughest one you've had to make in the last 6 months?
I say this to the team all the time. It's also relevant because obviously we are wrapping up some of our planning processes for 2026. We do make tough decisions, and the team will tell you sometimes it's not fun, but I remind them frequently. I'd rather be in this position than in any other position because we are in a growing, vibrant industry and we have more great opportunities that would be possible for us to invest against, whether that's resources or capital, than we could probably fund. So our job is to be discerning and try to be, extremely smart about the areas that we invest. So it's always tough, but I'll take this problem over the alternative problem any day.
But Erin, what decision kept you up at night last? I mean, we're looking for, was it a deal? Was it an acquisition? Something must have kept you up late trying to figure out if this was the right decision.
I wouldn't say that any of them have kept me up in terms of, are we making a mistake or not? What keeps me up is when we look at the different pathways we could take, and what the opportunity is. How do we make sure, given the variety of inputs, that we're choosing from the right category?
Right.
So,
Right.
confidential, so I'm not going to go into it right now, but that's where I spend more of my time worrying than frankly second guessing or worrying about a particular decision. We've got a couple of very attractive choices. Do
Right.
we double down? Do we kind of spread our bets, if you will, for where we are? Those are the things that we really think deeply about.
Where do you think Lyft is 3 years from now?
Oh my gosh. I mean, we're just on an incredible trajectory today. I think Lyft is the innovator in the industry. I think we are the service leader in our industry. I think we will continue to expand that across Europe, continue to expand that across Canada. I think we'll continue to penetrate deeply in our rider facing partnerships. And I think we will be sort of the poster child for what it looks like to have an extremely successful hybrid human-based, autonomous-based ride-hailing network. So that's where I see us 3 years from today.
Great. Well, Erin, it is so great to have you on the show. I want to thank you for joining us. That is Erin Brewer, the CFO of Lyft, and Anita Ramaswamy, our financial analysis columnist here at The Information.